I'm Mike Evers, Ortho World's digital content strategist, and I want to welcome you to our webinar on orthopedic market trends for 2020 and beyond. I appreciate you watching today and allowing us the opportunity to share our expertise with you. Our goal with this webinar is to bolster your knowledge of orthopedic market trends, top-tier company strategies, and the COVID recovery forecast. As an Ortho World member and a reader of the Orthopedic Industry Annual Report, some of these exhibits will be familiar to you. The numbers presented here are based on Ortho World's own methodology, whereby we bucket company revenue and overall market revenue into our main segments of joint replacement, spine, trauma, sports medicine, orthobiologics, and finally, other. We understand the challenge of reading the entire annual report, and we understand that COVID is an evolving situation that is impacting forecasts. This webinar provides 2019 highlights from the annual report and an update to 2020 forecast based on our first half numbers and our second half projections. So let's get started. So I think it's worth mentioning that as we look back to 2020 or 2019, we're 9 months into 2020. So looking back to 2019, I think is important for two reasons. Number one, it's our last snapshot of a quote unquote normal market. And I think number two, more importantly, as we review 2019 performance, you're going to see that there are some really strong underlying fundamentals in the orthopedic market that I think bode well for the market in years to come. So first, let's take an overall view of the segments for 2019. We estimate the orthopedic market grew 3.8% last year. And we also feel like that's about right. Anything in that 3 to 4% range, we believe is sustainable over the long term. However, I think there were a couple of surprises for 2019. Number one, even though knee replacement and hip replacement performed to our expectations, especially at the top amongst the largest players, there was some mixed performance. And I think some of the top companies are still facing challenges, even to this point, that they'll need to work through. And we'll delve into that in some more detail later. Number two, spine grew 3.5% in 2019. And I think a large part of that reason was the mid-tier companies in that, say, 100 million to 400 million range that really drove some aggressive growth. And I'll call out some examples of that as we review spine. And then my third surprise for last year was orthobiologics growing at 4%. In 2018, orthobiologics was under a tremendous amount of pressure. And last year it rebounded very well, especially in the viscose supplement subsegment. So we'll take a look at some of the drivers around that rebound as well. So for our first segment, let's jump into knee replacement. Knee replacement grew 2.9% last year. And I think more than any other segment, the growth drivers for knee replacement are very tightly interlinked. Robotics is a key driver for knee replacement. And what we've seen really over the last year is that a company's ability to get a robotic unit into an account is not only beneficial from the aspect of making that capital sale, but we're also seeing ASPs and the ability to upsell increase in accounts that have a robotic unit. For instance, Stryker, who is, kind of the market leader with Mako in terms of placement numbers, by the end of 2019, 30% of their knee replacement sales were cementless. And I think what we're going to see as we go into 2020, 2021, the next battleground for knee replacement is in the ASC. Especially companies like Smith & Nephew and Zimmer Biomet are really betting that knee replacement procedure trend towards ASCs continues. And they're finding ways not only to be ready to leverage that shift, but how can they tailor their robotic systems to the specific needs of ASCs? So I think the players who are able to do that, who are able to meld robotics and ASCs in a seamless manner, is going to have a real advantage in the next 3 to 4 years as that ASC procedure trend continues to accelerate. So for hip replacement, it grew 2.7%, again, about what we expect for hip replacement. Really the enabling technology of the day for hip replacement is navigation. A lot of the main players have hip navigation, but what we also saw in 2019 was increasing utilization for robotics for hip replacement. Mako utilization for hips was up 40% at the end of the year. And then in this year, in 2020, Stryker released all new software for their hip application on Mako. So that could be a further driver and uptake and utilization for hip replacement in robotics. Now, this is going to sort of be a common refrain you hear me say throughout the presentation, that Zimmer Biomet and Nephew, as you can see from their growth rates, continue to struggle at below market growth. And I think, for the most part, I feel like Zimmer Biomet has largely turned the corner, but I think there are still some significant challenges remaining for Nephew, and we'll talk about those both in some more detail coming up. As we go on to extremity joint replacement, the segment grew almost 7% in 2019, but clearly the elephant in the room for this segment is Stryker's acquisition of Wright Medical. That's going to vault Stryker really to the top of this segment. But what I'm interested to see is how Stryker is able to integrate Wright Medical. I think, in my personal opinion, there were some cultural and organizational problems at Wright even before the acquisition. So it'll be interesting to see how Stryker is able to manage through those during the integration process and what this segment looks like in the aftermath of all that. One of the other large trends that is developing in this segment is a discussion amongst the top players about how specialized should your sales force be when it comes to extremity joint replacement. Should it live in your trauma sales force? Should it live with your large joint sales force? Should it be completely separate and get additional investment and infrastructure? I think, for example, Zimmer Biomet is one of the companies that is leaning towards breaking out a specialized sales force here. And I think they're probably in line to pick up a lot of the folks that are let go in the integration process from Stryker and Wright Medical. So I think that will bolster Zimmer Biomet's sales force in this segment. And then I think we're going to see just further knock-on effects, a ripple effect from that integration process, where we'll see how sticky some accounts are, and if there's some market share shift due to the disruption in this segment from that acquisition. Spine sales, like knee replacement, robotics is a major factor here. You see that spine grew 3.5%, which is a really strong result for a segment as big as spine. And I think a large part of the reason is robotics. Now, the space for robotics in spine is getting more crowded. And I think you would hear some detractors say that there's very little differentiation between robot units in spine. And really all they do is pedicle screws. And I think some of the companies that don't have robots or are not convinced on it, one of the ways they're keeping pace is what I'm calling surgical approaches. There's been a significant shift in the way companies sell to their spine accounts, where they're no longer concentrating on specific product lines or specific implants. They're looking at the entire procedure as it treats a specific pathology. So they're integrating their implants, their instruments, their biologics, all of the enabling technology that they do have. And that's really been a significant driver And we've seen it in companies like Nuvasive, Globus Medical, and ATEC Spine. It's really had an uplift on revenue per procedure. Those companies have had a lot of success with that throughout the last kind of year, 2 years. So where I think spinal robotics is the next kind of line in the sand for spinal robotics, and who's going to be able to differentiate themselves, is whoever's able to integrate AI-driven surgical planning in their enabling technology. And I think the best example we've seen of that recently is Medtronic's acquisition of Medicrea to get their AI-driven surgical planning software and customizable implants. And I think that is really going to be where some companies start to move ahead of others. And then, as I said earlier, one of the surprises for me for spine in 2019 was the strength of the mid-tier companies kind of below this mark here. A couple examples for 2019: Spinal Elements grew 9%, RTI Surgical grew 19%. As I mentioned, ATEC Spine, 24% growth in 2019. And then C-Spine, a little bit lower in the tier at 14% growth. So they comprise a really aggressively growing core of companies just below this mark here. Trauma grew 3.4%. And I think where we're going to start seeing a lot of movement in trauma is in these smaller subsegments that are more specialized, like foot and ankle and pediatrics. In foot and ankle, smaller privately held companies like Paragon 28 and Novastep are really making some good headway. And I think it was those kinds of companies that Wright Medical was referring to several quarters ago when they said they were in, quote unquote, a knife fight with smaller companies that were taking market share from them. So I'm interested to see, as Stryker goes through the integration process with Wright Medical, are they able to fend off these smaller, more agile companies, or will they kind of find some of the same obstacles that Wright Medical was dealing with? And then as we look at pediatrics, we've seen recently some of the larger players launch pediatric lines and line extensions, but I don't think anyone gives it the kind of focus that the company Orthopedic does. So I think it's going to take quite a bit to compete with Orthopedics within this subsegment. I don't know that any of the larger players have the specific focus to do it. And then finally, I think also this is one of the primary segments where you're going to see effects from that disruption of Stryker and Wright Medical, and those ripple effects as the sales force is, I think, largely probably disbanded by Stryker and moves on to other companies. And we'll see how that plays out with some of the accounts that they used to call on. Sports medicine grew 5.5%. And like spine, there is a big focus in sports medicine on procedural thinking, where you're not thinking of selling, a specific product, but you're trying to convert an entire operating room to a Arthrex operating room or a Smith & Nephew operating room. And that way you can get more of the available dollars from that account. And that's really been, in 2019, it was a stumbling block for Smith & Nephew and ConMed, because both of those companies had aging capital equipment portfolios. And for Smith & Nephew, that had been a headwind for quite a long time. However, in Q4 of 2019, we saw Smith & Nephew have some key launches like ablation wands, their Lens 4K, that really got them over that hump. And I think what you'll see as COVID kind of eventually evens out and normalizes, you'll see Smith & Nephew to continue to perform better in that specific segment of their capital equipment portfolio. The other thing that I'm really watching in sports medicine is regenerative medicine. And when I say that, the first company I think of is Anika Therapeutics. they're a super interesting story in that I think really just 18 months ago, 24 months ago, they were not much different than a contract manufacturer. And they've had a complete transformation since then to a fully commercialized enterprise. And one of the biggest steps in that journey was their acquisition of Parcus Medical and Arthrosurface. And really the key benefit there for Anika was it expanded greatly their points of call for sales. Anika used to only be in doctors' offices, but now they're in hospitals, they're in ASCs, they're in ORs, and they have some really compelling cross-selling opportunities with now their expanded sports medicine portfolio, their traditional sports medicine portfolio, and their regenerative medicine portfolio. So I think Anika is going to really hit a kind of a sequence of rapid growth here over the next little bit. And then finally, as we go to Ortho Biologics grew 4% in 2019. And I think a big part of that, right, is the return of visco supplements. Two quick anecdotes that really sum up the comeback story here for me is that in 2018, the company Sanofi was down 20%. Like they fell off a cliff in 2018. And you can see here, even though they still struggle, they closed that gap quite a bit. And then just as we were talking a moment ago about Anika Therapeutics, they had a sales arrangement, a sales agreement with a third-party vendor where Anika would get milestone payments. In 2018, even though Anika Therapeutics volume was up, they were selling more orthobiologics, price pressure was so great that it was mathematically impossible for them to earn those milestone payments despite the increased volume. So really just a summation of how great the price pressure was in 2018 for visco supplements. We've seen that stabilize in 2019 and really contribute to the rebound overall of this segment. The other thing in 2019 that really caught me by surprise was Medtronic's BMP issues. In a previous career, I worked in cardiac rhythm management, so I was very familiar with Medtronic. And the way all of those companies sold was sell everything via bulk buy in the last 3 days of the quarter. It was miserable for everyone. It was highly stressful, and it led to falling ASPs. It didn't seem sustainable. So I was really surprised when I came over to orthopedics and saw that Medtronic is still selling that way for at least their orthobiologics. And at the end of 2019, they had a big miss. They were not able to finalize those bulk buys by the end of the quarter. So they had a big time miss. And, I think it caused significant problems inside of Medtronic, and they've made some organizational changes to make sure that doesn't happen again. And then like spine, strength in the mid-tier is a big driver for orthobiologics and the rebound. You look at Japanese player Sekigaku, up 11% in 2019. Anika, that I just mentioned, up 8%. And then Vericel, up 35%. So I think Vericel is a really interesting company to watch in that lower end of the tier as they're growing by leaps and bounds. So let's kind of bring it back, sum up our overview of the segment. 3 quick takeaways. The market has strong underlying fundamentals. I think it's sustainable for years to come. And I think these are kind of the fundamentals that are foundational, that'll be there, COVID or no COVID. We see that there are still some challenges at the top tier. Companies like Nephew and Zimmer Biomet are still facing some portfolio gaps, some organizational problems, and they're still losing share in several of the segments. And then as we talked about, strength in the mid-tier for several segments. Companies like Atex Spine, Globus Medical. Globus is kind of right at that edge, right? Not going to be able to call them a mid-tier company much longer. But certainly Globus, very successful 2019 in orthobiologics, Anika and Vericel, also really strong performers. All right, so now let's Let's drill down a little bit into specific company performance. And what we're going to look at today is the 2019 performance of public companies over $1 billion in annual revenue, like the real top tier players. So an overall look here, as I mentioned, Nephew, Zimmer Biomet, still in 2019, significantly challenged. But I would say of those two, Zimmer Biomet is really probably turned the corner by this point in 2020. But I still need to see some things from Nephew that can convince me that they're on the right track. So let's talk about Nephew. Okay, so in 2019, negative 0.5%. And as I mentioned, they're still dealing with some portfolio gaps that leave them vulnerable to losing share. And until recently, a cementless knee was one of those portfolio gaps. Now they did launch a tuned cementless, which I think is going to go part of the way in closing that gap. But the other big gap that they have is their enabling technology. They've named their digital ecosystem, which is all of their navigation, their eventual robotics, that whole thing they've named VELYS. But at the time of launch, it was hip navigation and I think a couple instruments. Everything else was either still in development or purely conceptual at that point. And I don't think their robotic component is even going to the FDA for approval until maybe 2022. So by the time they are in the market and selling these in accounts, where is Stryker going to be? Where is Zimmer Biomet going to be? I mean, at the end of 2019, Stryker had almost 900 Mako robots in the field. By the end of this year, Zimmer Biomet's probably going to have 200 to 300 ROSA knee units. So that's just such a profound head start for those companies. I'm not clear on how VELYS is going to gain much traction. However, one way that I can see it is if Nephew can leverage the AI capabilities of their parent company, Johnson & Johnson. They mentioned this briefly in an earnings call a while ago, not specifically about orthopedics, but they did mention that through the product development pipeline of pharmaceuticals, they heavily use AI and machine learning. If the company is able to port some of that capability over into VELYS and into their orthopedic enabling technology, I think that could be a true differentiator for them, and maybe one of the ways that they come in so late to the game, but are still able to make some headway there. So let's talk about Stryker. Stryker grew 5.6% in 2019, and Stryker's just been on a phenomenal run the last several quarters. And a part of that reason is, as I mentioned, Mako's acceleration. 860 robots at the end of 2019 in the field, and all of the utilization metrics were going up significantly at the end of Q4. We also saw, despite a lot of people's assumptions, that they've been able to continue to move robots in 2020. And they called Q2 of this year a very pleasant surprise in terms of Mako placements. So Stryker is continuing to lead the market there. What I do worry about, however, for Stryker is integration fatigue. When Stryker acquired K2M a while ago, Stryker was, I think, a fair consensus of people regarded them as the masters of integration. They do it exceptionally well. But what we saw with K2M's integration is they stumbled there. The Salesforce integration piece took far longer than expected. They had supply issues. They had product development issues. And all of that is pre-COVID, right? So what is it going to look like as Stryker tries to integrate Wright Medical during COVID? And also, as I mentioned previously, it's my feeling that Wright Medical had some cultural issues at work, as well as some organizational issues. So I'm interested to see how that all plays out for Stryker. And then I think the other thing for Stryker is to find a way to replicate their success in joint replacement in some of their smaller segments like sports medicine. They often talk about finding scale in the replicating that success. So that's the other thing. I think to do that, they'll have to have some more infrastructure and focus there, but it's certainly something on Stryker's mind. Zimmer Biomet, the other big player that was challenged through 2019, grew almost 0.5%. But as I mentioned, I have a feeling that they are untracked and on the right path. Launching ROSA Knee was a huge step for them. And they've been, I think, more than any other big player, really consistent and clear in their messaging about robotics and enabling technology and how it's going to be their new focus. They really want to drive efficiency in the procedure, and the way they're going to do that is through these enabling technologies. And I think that's really a good play for them. You know, they're high volume in knees and hips. So if they're able to get their high volume surgeons these products that raise ASP, that enable upselling, but don't hinder them in their volume, I think that's going to be a strong play for them. Like Stryker, Zimmer Biomet has talked about investing in some of their segments that have potential but are underperforming relative to where they think they should be. Sports medicine is one of those examples. But by the very nature of that statement, if you're going to focus more on some things, that means reduced focus somewhere else. A lot of analysts have read that as divestment. And although Zimmer Biomet hasn't come out and say it, I think in the next little bit here, we could see a possible divestment of Zimmer Biomet's dental franchise, as well as their spine franchise, a chronic underperformer for them. They've talked about not treating all of their business lines the same. So I could definitely see spine being one of those segments that they get out from under. And, you know, it's a bit of an open question as to who would be in line for that kind of purchase. But my own guess is a company with a really strong balance sheet that needs like a big bump to get over into the next tier is a company like Globus Medical that might be a potential buyer if Zimmer Biomet does, in fact, divest their spine business. Smith & Nephew grew a little bit more than 4% in 2019. And we already talked about part of the reason being their reinvigorated sports medicine capital sales. You know, like I said, some of the well-timed launches at the end of last year turned that business around for them and was a big factor in their growth. The next thing for for Smith & Nephew is going to be their next generation robot named Corey, and how it is sort of laser focused on ASCs. Smith & Nephew already has a very large ASC presence thanks to their sports medicine franchise. So the question for them is, how are they going to be able to leverage that for joint replacement as those procedures continue to move to the ASC? And how are they going to be able to use their next generation robot, Corey, to really capitalize on that? Corey is CT free, and I believe is going to be less of an expense than some of the competitors' robotic units. So I think it's really tailored to ASCs. And I think Smith & Nephew is in a very strong position to be able to be at the forefront of that market as it continues to grow. Medtronic grew 2.1% last year. And as we already talked about, they're kind of snafu in biologics with their big bulk buy miss at the end of the year. But where they have had success is what they call surgical synergy. And that's their name for this idea within spine of procedural selling everything you need to treat a specific pathology in a way that more closely mirrors how surgeons think. And it has been a good growth driver for them in their core spine franchise. I think one of the things that Medtronic is very sensitive to is this perception out there that Globus Medical's Excelsius GPS is a superior system, a superior robotic system to Medtronic's Mazor. pretty much every quarter that I can remember going back since I came into orthopedics, Medtronic has made a point to say we placed far more robotic units this quarter than our competitor. But I think one of the ways Medtronic is now going to try to close that gap in perception is through the Medicrea acquisition, where they're now going to have AI-driven surgical planning and customized implants. And I think this is going to be this kind of increased focus on enabling technology and technology overall is going to be a really a key focus area for Medtronic going forward. In their Q2 earnings call, they said that they aim now to put the tech in med tech. So I think this is going to be a big area of focus for them going forward. And then finally, we'll take a look at Nuvasive. Nuvasive, 6% growth in 2019, really good result, driven primarily through their efforts of procedural selling and in their focus on driving efficiency in procedures. You see over here, X360 is Nuvasive's proprietary single position lateral surgery that's aimed at saving time and money. And according to them, in just a couple months, it saved $14 million in medical cost. But really the storm brewing on the horizon for Nuvasive that I see is the continued delay of Pulse. Pulse is their ecosystem of enabling technologies that is supposed to be very highly modular and therefore can serve multiple purposes and be very versatile and cover the entirety of spine surgery. However, what we saw was some continuing delays, and then Nuvasive pulled all of the alpha testing units they had in the field for quote unquote component level changes, which sounds fairly ominous to me. What we also saw was this further delayed the robotic component of Pulse. And Nuvasive has been very open in the fact that COVID has made it difficult for them to get qualified and skilled engineers in the door. So that has led to further delays. And we're probably looking at 2022 for their robotic component for Pulse. And I think that's really going to open the door for some of their competitors. And it'll be interesting to see how far the continued focus on proceduralization and proprietary surgical approaches can carry Nuvasive as they try to wait out this Pulse delay. So if we're going to sum up our takeaways for the top players, number one, enabling technology is a big focus. And, you know, I think people smarter than me can debate its clinical merits, but what is not in doubt at all is that these technologies are revenue drivers, and not only in the capital purchase one-time thing, it's their annuities, their service contracts, disposables, and we've seen them throughout an account drive up ASPs overall in that account. So clearly companies are taking notice and focusing on this more and more. Second takeaway is we're going to see some market disruption from Stryker's acquisition of Wright Medical. I think it's pretty clear at this point that they're not going to retain many of the sales people from Wright Medical. So we'll see where those people land. I suspect a good portion of them will go to Zimmer Biomet. And then procedural selling is another continuing focus, and beyond robotics and enabling technology, another way for players to get more revenue per procedure, more revenue per surgery, and take more of the available dollars in that account and consolidate it in their own company. So let's take a look now at COVID, and we'll start with what COVID has done to this point to the market at the half, and then we'll take a look at maybe what it has in store for us in the back half of the year, as well as maybe some of the lasting impacts that we can expect. So at the half, we estimate the market was down approximately 20.5%, maybe 21% for the half. That is a far better result, frankly, than we expected. If you recall, Q2 was supposed to be doomsday. Many of the companies, many analysts were predicting declines in the 60 to 70% range for Q2 overall. And we performed much better than that. I think the reason is almost primarily is because of the backlog. And when I talk about backlog, I'm referring specifically to that cohort of patients that were scheduled for surgery in that March to early May timeframe that got deferred as we saw all the shutdowns spread throughout the United States. So what we saw is a much quicker resumption of those procedures and a depletion of that backlog much quicker than we expected. We estimate about 50% of those surgeries are remaining after Q2. So that was a big part of the reason that we came in above or ahead of the curve as to where we expected. However, the concern is as surgeons focus on getting through their backlog, they're not doing as many surgical consults, which leads to fewer patient candidates down the line. In addition to that, you're going to have some lingering patient fear, some patient sentiment about going into hospitals at this point and having surgery at this point. And then also unemployment in the United States is very high. And as people lose medical coverage, that's going to have a depressing effect on surgical volumes as well. And even in countries with nationalized healthcare, folks out of work are not going to tend to go get their knee replaced. So I think overall, as unemployment remains high, that's going to taper the recovery on the back half of the year. So let's take a look at the rest of 2020. And let's quickly talk through the recovery ramp. So in Q1, we saw the market down about 10%. And then in Q2, about 35%. But again, that represents the low point, but not nearly as bad as many of us expected. As we go into Q3, we expect some effect from seasonality. Q3, generally a little bit of a slower time. We're not sure how much that will be at play in these unprecedented times, but we do expect the taper effect on the recovery. Now, it will continue to improve sequentially, but I think that the rate of increase will taper off. And so we're saying about negative 10% in Q3. In Q4, there is a chance that we can get to flat, so about to where we were in Q4 of 2019. However, for that to happen, a lot of things have to go right. The cards have to fall pretty much perfectly. That means no big resurgence of COVID. It means, and it's we're already at very high levels, but no resurgence to the point where we're seeing procedural restrictions again. It also means we don't have a devastating flu season in the fall. And it also means that in November, the US elections have, and forget, the result of the election process itself plays out somewhat normally. And that doesn't create some kind of uncertainty in the market. If all those things happen, there's a chance that we can get back to flat in Q4. If this recovery ramp holds true, we see the overall market down about 12.4% for 2020. And what we believe we'll continue to see resilience in hips and trauma as they are less elective than the rest of the procedures. And even though it ended up not being true that capital sales were off the table, we do expect them to remain pressured at least throughout the end of this year. So now let's talk about longer out, another 18 months from now. What are some of the lasting impacts that we might see from COVID? Well, we definitely feel like we're going to see the market consolidate, whether that's from smaller players just running out of money or being acquired. It could also mean that hospitals pare back their vendor list, which I believe will disproportionately impact smaller, more specialized players. We could see some purchasing models evolve over time. We haven't seen that to this point, where price premiums become more pressured and price pressure increases, but that's certainly a possibility. And then the next one here, I think, is the most likely and the most relevant, and I think will have the longest impact, where it's not just reduced travel. I think as companies restricted their cash outlay, they recognized how successful they could still be, that they could still drive results. And the example that really pops into my mind is Stryker. Stryker is traditionally a very high touch culture. They travel a lot, they gather a lot, they have a lot of real estate for a lot of offices. And in their Q2 comments, they spoke about how surprised they were that they could still drive results, even though that they had restricted a lot of this spending and suspended a lot of that travel. So what I think you're going to see is increased virtual education. That's going to stay, and that's only going to increase from here. I think industry travel will remain lower than it had been. And I think you're going to see some of these larger players reduce their real estate footprint and go to more work from home arrangements throughout their organization. And then finally, I'm not sure we've witnessed this yet, or to a meaningful extent, but as hospitals and any OR implements safety measures, how is that going to impact their overall efficiency? Is the throughput of the industry going to be reduced by an appreciable amount? So that's certainly possible, but I think it could be offset by the increased focus on efficiency from the OEMs. So at this point, we're going to take a detailed look at 3 specific trends and how COVID impacted them. We'll look at enabling technologies, we'll look at M&A, and we'll look at the procedure acceleration into ASCs. Because I think the first half of 2020 did bring some surprises in all 3 of these areas here. As I mentioned, Brian Hansen from Zimmer Biomet has been among the most vocal in talking about their shift in their bias, as he calls it, towards robotics and informatics. So what does that look like? What does that mean? If we look here, and if we only consider robotics, right, if we're not even talking about overall enabling technologies, we're only looking at robotic systems, these companies here all either have or are actively developing a robot. And by revenue, that's 62% of the market. So a big inertial force in the market is pushing towards robotics. And for COVID, like I said, we expected, or some folks did, that, you know, as hospitals are cash restricted and dealing with COVID, that you don't even bring up capital purchases in this environment. It's the wrong thing to do. That ended up not being the case. We saw that Stryker had a very successful Q2 with Mako. We saw Zimmer Biomet have some really good success in Q2 with Rose and Knee, and Smith and Nephew sold their first Corey robot in Q2. So clearly, if your technology is compelling enough, there's still the opportunity to make capital equipment sales in this environment. The market is getting increasingly crowded for robotics, so we expect to see longer buying cycles at hospitals, longer evaluation periods, and I think it will drive the need to differentiate. Like I said, of DePuy Synthes and Velis, if they come out with a robot that does everything their competitors do, I have a hard time seeing how they're going to gain traction in the market with an offering like that. So companies will increasingly have to have differentiated offerings in robotics. It won't be enough to just have a robot. And finally, worth mentioning, I'm not sure how meaningful it is in this isolated incident, but some analysts ran a survey of 600 surgeons, not all of them orthopedic, asking, compared to pre-COVID times, how likely are you to use robotics as you process your procedure backlog? And the survey showed about a 6% fall off compared to pre-COVID. Certainly not staggering, and it could be, the efficiency piece where surgeons are more inclined to just get through these procedures as quickly as possible. But worth keeping in mind that the survey showed a slight fall off in the precedence of robotics as surgeons complete their backlog. So as we move on to M&A, so it did seem like as we got into COVID and companies are in cash conservation mode, that M&A would be reduced greatly. And I think to a certain extent that's true for large acquisitions. But we actually saw it spur a lot of tuck-ins. And Medtronic is a great example of that with their acquisition of Medicrea. Who knows at what price they were willing to make this deal, but as assets become stressed due to COVID, it might make more sense for some of these companies with strong balance sheets to make that tuck-in acquisition now. So what we expect to see with the COVID impact is cash poor companies, small companies, developmental stage companies are going to be under a lot of pressure. And we expect that to lead to, at least in the short term, a slight slowdown in innovation. Not all companies can afford to double down on R&D during COVID like the big players can. So I think we'll see a slight slowdown there. As we saw with Medtronic, we'll see increased tuck-in activity as cash-rich players can get more aggressive in the market. And then vendor consolidation. We might see hospitals, as they try to reduce foot traffic, pare down their vendor list. And really that plays into the hands of a highly diversified company that can offer a full bag. So as I said, I think that disproportionately impacts a small specialized company, which may drive them to seek acquisition. And then finally, on the acceleration of procedures into ASCs. A company like Smith & Nephew is, as I said, at the forefront of that. But I think there was a perception early on, in Q1, certainly among analysts, that COVID was going to herald that switch that got clicked over and really began the flood of procedures into ASCs. But in actuality, we haven't really seen that happen. We have seen some modest acceleration into ASCs due to COVID. An example would be fracture care. We're seeing increased incidence of fracture care happening in ASCs, but we don't believe that these procedures are going to stay in ASCs. As COVID eventually evens out and we adapt to it, I think a lot of these procedures are going to go back to central hospitals. And I think really the reason that COVID hasn't been that transformative event that kickstarts ASCs to where we all think they're going is there's just not the capacity. There's not enough ASCs to handle this flood of procedures. But what we do see is increased focus from the top players on ASCs. For example, Stryker has their all-in-one ASC plan where they'll help finance it, they'll help build it, they'll supply you with all their portfolio. We see with Smith & Nephew building a robot really specifically with ASCs in mind. And then Zimmer Biomet taking great pains to make ROSA a good option for their high volume surgeons. And I think that plays well with ASCs as well. So clearly the largest players know in the next 3 to 5 years, this big acceleration is coming. But I think to get there needs to be some infrastructure work done and more capacity built for ASCs. All right, so to wrap up our COVID talk, 3 quick points. For 2020, figure we're down about 13%. Better result than we initially thought, but clearly some still ground to be made up in 2021. We expect some consolidation in the market, and that's going to be through some smaller companies simply running out of money. Some are going to get acquired, and we could potentially see hospitals pare down their vendor list that lead to further consolidation. And then finally, lower costs for companies. Companies have realized that they can still be successful at a lower cost than previously thought. And I think we're going to see, reduced travel, increased virtual education, and a reduction in real estate footprint for some of these larger players. And I think that's going to stick around and become sort of the new normal in our industry going forward. And now we're in this home stretch here, but I just wanted to add this quick little appendix, so to speak, because if you followed COVID, if you followed the orthopedic industry through COVID, it probably didn't take you very long to come upon two conflicting statements that seemed mutually exclusive from very smart people. And I think that really speaks to, even 9 months into COVID now, it's still a highly fluid situation, and it's a highly nuanced one. So I would just like to give three quick examples of these seemingly conflicting statements and how the truth, more than one thing could be true. So here we're talking about the backlog recovery rate. And as in Q1, as we were looking ahead to Q2, there was this perception that, docs were just going to live in the hospital and do procedures 24 hours a day. And that's how we were going to recover very rapidly and get back to even in this year. But Joe Wolk from Johnson & Johnson said, look, number one, doctors aren't going to do that. Even if they did, it would only increase capacity by about 30% at the top end. However, Kevin Lobo from Stryker said, listen, the docs I've spoken to want to do their procedures. They want to make their money. So we're expecting a very rapid recovery. And as we saw through the half, they're both partially right. We did recover much quicker than we anticipated, but we are still, even at the end of the year, going to have a good portion of the way to go. I mentioned price pressure a little bit earlier, maybe new purchasing models developing out of this. Dr. Steele, who is a orthopedic surgeon and entrepreneur, was speaking to Patrick Vega, and he said that he anticipates COVID to lead to kind of increased price transparency and some more price pressure, and really kind of a market correction. So only truly differentiated products get a premium. And honestly, that hasn't happened to this point. We've sort of always lived in that 2 to 3% price pressure world. And according to Brian Hansen from Zimmer Biomet, that's where we continue to be. And he doesn't expect that to deviate greatly at all. And then finally, on ASC acceleration, we again, I think many of us sense that this could be a big boon for ASCs as more procedures moved in there. However, I think a quote that illustrates the problem very well is Catherine Owen from Stryker said there's only about 300 ASCs in the US that do hip and knee procedures. And even before COVID, they were operating at max capacity. There's just not enough space, not enough capacity to take these flood of procedures. Now, what we do think, though, is as that capacity is built, as reimbursement improves, as some changes in CMS come along, we will see that rapid growth in the next 3 to 5 years. It's just not ready yet. Like anything in med tech, it's slow incremental progress. All right, so you've made it this far. Thank you all for bearing with me. If you remember only one slide from the entire presentation, make it this one. 3 quick takeaways. The orthopedic market has very strong fundamentals that undergird the entire industry, and they will remain there throughout COVID. Enabling technology. Some of us are probably tired of reading about it. I'm certainly tired of writing about it sometimes, but undeniably, it is a revenue driver, and more companies are trying to leverage these things to increase their growth and their revenue. And then finally, the lasting impacts from COVID with cost reduction, reduced travel, more virtual education. I think those are the things that are going to be with us long term. That concludes my presentation. From all of us at Ortho World, thank you for allowing us the opportunity to bolster your industry knowledge. But before you go, I want to let you know that we welcome your suggestions for future topics, and we welcome the opportunity to bring a custom presentation into your organization. Whether you'd like to educate new hires or provide your sales and executive teams with customer or competitor insights, we're here for you. Let us know how we can help. Utilize the contact form on orthoworld.com, or you can contact me directly via email. See you next time. Goodbye.